All right, hello, y'all. This is Carter, and today I'm going to be talking about the time value of money. This is a super important concept for investing in finance as a whole. It's also pretty tricky to understand intuitively. I remember at first I had a hard time understanding what this meant. I'm hoping to build on what we've learned the last few lessons about cash flows and risk and reward, and I hope that I can explain it to y'all in a way that you will understand. But first, let's review a little bit. So, in the last few videos, I talked a lot about cash flows, risk, and reward. So, let's remember that the value of any company or asset is the present value of its future free cash flows. And also, that the more risky an investment, the more of a return an investor will demand to be compensated for that risk. And the risk free rate sets a benchmark for the rate of return of all other investments. So, this kind of arbitrary risk free rate, usually we just use the 10-year US Treasury bill as our risk free rate. If this changes, then all other investment returns will change as a result. If you can get a higher return from a risk free asset, then likely, investments that are they deem to be kind of risky, people are going to demand higher returns to match the risk that they are incurring. So when we say present value, when I say present value of future free cash flows, what does that even mean? Well, that has to do with the time value of money. So what I'm going to be talking about today. So hopefully by the end of this, you'll understand what I mean when I say present value of cash flows. So time value of money. This is the concept that a cash flow is worth more now than the same cash flow will be worth at a future date. So a lot of times people say to explain this concept, a dollar today is worth more than a dollar tomorrow. So as a result, we care more about the cash flows that are happening at an earlier date. A cash flow that I can get a year from now is worth more than a cash flow that I can get 5 years from now. You might be intuitively thinking, yeah, Carter, that makes sense. Inflation. For the sake of this video, I just want y'all to ignore inflation as a whole. While yes, inflation does mean that money today is worth more than in the future, it's not really the concept behind the time value of money. I'm going to be talking about what that really means here in a second. But just know that cash flows, today are worth more than cash flows tomorrow. That's the general principle. So why is this? Why does this work? Well, it is because I have the ability to invest this money and earn a return. If I have a dollar today, I could give it to my friend Joe and be like, hey, you can have this, give it to me $1.01 tomorrow, we'll be square. See, you can get a return on this, and we all can invest in our bank and get that small interest rate, or invest in stocks and get a return there. So that is why money today is worth more than money in the future, because we can invest that money and get a return. So like if I can get a 10% annual return by investing in a financial asset, what is a cash flow of $100 in 5 years really worth to me right now? That's kind of the whole thing we're trying to figure out with this video. If an asset is giving me a cash flow of $1,000 in 10 years, what is the present value of that cash flow? And today in this video, I'll answer that. So yeah, before we can kind of figure out how to get the present value of a cash flow, I'm going to explain how you can get the future value of cash that you have right now. So let's say today I have $10. And the value of that $10 in 5 years from now is $16.10 if I seek to invest in an asset that is risky enough to give me a 10% annual return. Well, the future value of this $10, assuming that I am investing in an asset of such risk that I get 10% return, is going to be $16.10. So, fundamentally, the future value of any cash flow depends on the return of the investment, so the amount of risk that I am comfortable taking, because risk and reward are correlated, and how long I will stay invested. If it's 100 years from now, the future value of $10 is going to be a lot more. I'm sure y'all have heard people, people that talk about personal finance. They're like, Carter or someone, the $5 you spend on a Starbucks coffee, if you invested that money into a Roth IRA, it would be worth $1 million something 50 years from now. That's kind of the principle of, money now compounding to be more in the future. That is why the future value of $10 now is $16.10 in this case, because I can earn that 10% annual return. So here's the future value equation. The future value is the present value times 1 plus the discount rate to the power of the number of periods. So in this case, $10, the present value of my money right now, I have a $10 bill. That means because we're in the present value is $10. 1 plus the discount rate, which is the return, which I'll explain more what discount rate is in a second. 1 plus the return to the fifth power, the number of years, that equals $16.10. So that's how we get from present value, $10, to future value. Now let's talk about present value, which is much more relevant for us because when we think of an investment, we want to think about the present value of these cash flows. We want to think about all cash flows and present value. Because if I'm thinking of an investment that's going to give me $10 each year, each of these $10 is really worth a different amount to me because of the way that the time value of money works. So it's easiest to compare cash flows if we just bring them all back to the present. This is the easiest way to see if an investment is worth it to pursue. And I'm going to, elaborate a lot more on that. But now to find the present value, it's basically the opposite of the future value. If I received $16.10 from an investment I made 5 years ago, what is the present value of this? Well, it is the opposite. Instead of multiplying the present value times this discount rate to the fifth power, we are going to divide it. So, we're going to do $16.10 divided by 1.1 to the fifth power to get to $10. This is called discounting. We are discounting here. Previously, we were compounding. Now we are discounting. So the present value of any investment depends on how far out the cash flows in the future and the discount rate. The higher the discount rate is, the lower the present value is going to be. The further out in the future it is, the less this cash flow will be worth to me now. And here's the formula here. You can see why both of these things make sense. So as you can see here, the variables are, the future value, the discount rate, and the number of periods. So what is the discount rate? I kind of said, it's 10%. It's the rate of the return. But it's a bit more complex than this. It has to do with the amount of risk you are comfortable taking. The discount rate is, and I'm being very careful about the words I'm selecting here, it is the rate of return that can be earned from the next best alternative investment opportunity with a similar risk profile. So it's kind of like the opportunity cost. It's the best return you can get from an investment of that risk profile. Another definition that means the exact same thing, also, I very carefully chose these words, the expected rate of return. You might be wondering, Carter, these don't seem like the same things. You said one is kind of this opportunity cost, the next best alternative. Now you're saying it's the expected rate of return. These are fundamentally different things. Well, the reason is because I put in the words expected here, because I am saying expected. If I am investing in an asset of a certain risk profile, I will expect to make a return that is worth that risk. Meaning that if some other alternative investment is paying me a higher return to invest in that than the one I'm thinking about investing in, well, I'm going to expect to make the same return as them. You see what I mean here? I am going to demand that, and that's the only way that I can truly be compensated for the risk that I am incurring. If I'm, if there's two lemonade stands, my lemonade stand and Joe's lemonade stand, and they're both, the same risk level, we're in the same area, same equipment, same risk level. I ask for $10 and I get 5% return. Joe asks for $10 and gives 7% return. The investors that invest money in mine, they are going to pretty much demand that I give them 7%. And that's kind of how markets work. They're almost efficient in this way. Risk and reward is almost like completely correlated here. You're not going to be able to find that many risk adjusted, like really good returns. Almost every investment of similar risk is going to give about the same reward because investors are going to demand to be compensated for the risk that they are incurring. I apologize for this little rant, but it's very important to understand here how discount rate kind of shows opportunity cost, the next best alternative investment opportunity, but that we as investors demand to be compensated the same as that next best alternative investment opportunity if we're going to incur the same amount of risk. So discount rate is very much associated with risk. Given my risk tolerance, what return do I seek? And I'm going to give a little example here so that you can better understand this. But just know that discount rate is, at its most core, the expected rate of return, and it can also be used as a proxy for risk. An investment with a discount rate of 50% is going to be much more risky than an investment with a discount rate of 5%. And if this doesn't make much sense to you right now, I completely understand. It's hard to understand at first, but I'm hoping through some examples, I'll be able to explain it in a way that's a bit more clear. So here's an example. Here's how we find a discount rate. Let's say I invest in the bonds of Carter and I am promised 10% annual coupons. So that means the bond is $100. I'm investing $100 and I get 10% annual returns. And investments of similar risk also pay investors 10% annual returns. So same risk as mine, they're giving the same returns. What is the discount rate we should use to discount cash flows back to present value? Well, it seems that investments of similar risk are promising to pay investors the same 10% returns. So that is the discount rate. However, with this example where Carter bonds are still paying 10% annual returns, however, interest rates have gone up around the US, making it where similar risk investments are now paying 12% annual returns. What is the discount rate now? Well, now the discount rate should be 12% because investments of the same risk are offering better returns. This is why this year, when the Federal Reserve increased the risk-free rate, essentially, that made it where all these stock prices went down because the present value of all these cash flows went down as a result of the discount rate increasing. Investors demanded more of a return for the amount of risk they were incurring because the benchmark for risk, the risk-free rate, it went up. So that is why the discount rate is the return of the next best alternative, also known as the expected rate of return. People that invest in Carter bonds are now going to expect 12% annual returns, or else they're just not going to invest in it. But markets are almost efficient, so Carter bonds will most likely go down in value. So then the yield on those bonds will be 12%. You might not understand what that means, yield. My next video, I'm going to talk extensively about bonds, the discount rate, yield, face value, all of that stuff. So make sure to watch that one. But now let's kind of show the math of how we calculate what a bond is worth. Let's say we have Carter bonds, we buy them for $100 and 3-year bond, 10% coupon. So for 3 years, going to receive $10 from me, and they're $100 at the very end. So the cash flows are looking like this. I'm investing $100. I'm getting 10 at the end of year 1, 10 at the end of year 2, and then 110, the principal and the $10 coupon at the end of year 3. And the discount rate, what are we saying the discount rate is? Well, at the beginning, before the Federal Reserve increases rates, discount rate is 10% because investments of similar risk are also offering 10% returns. So we're going to discount all these cash flows with a 10% discount rate. So year 1, we see it's worth more than in year 2 because it's 1.1 to the second power instead of 1.1 to the first power, kind of seeing this compounding effect. So, and then in year 3, 1.1 to the third power, it's being discounted back, even higher, so present value is now 82.65. And if we're adding up the present value of all these cash flows, this is what we always do. We're always going to add up the present value so we can evaluate an investment right now. It is equal to $100. The present value of the cash flows is equal to $100. So that means that the present value of the bond's cash flows equal the face value, the principal of the bond, meaning the bond is trading at par. But what if the discount rate goes up? What if now bonds of similar risk are going to offer 12% returns? Well, we'll see here. Now they're going to get discounted back at a higher rate. And the present value of these cash flows is going to be $95.20. That's going to be the present value of these cash flows. So assuming the market is efficient, which it almost is, they're going to recognize this. So the bonds of Carter are going to go down in price about 5% because they are going to demand yield to be, the same, to be about 12%. They're not going to invest in an asset that gives them 10% when they can invest in another asset with similar risk that gives them 12%. So now the bonds are going to trade below par. So that's what happens when interest rates go up all around the world. The prices of bonds right now are going to go down. These people are just immediately going to buy these new bonds that give them better returns. It's all about opportunity cost. I'm sorry if I keep going on tangents, but this is just very essential. So what about the cash flows of a company? I talked about bonds, but it's a bit different because a bond has a set cash flow. So like, I'm going to give you $10 each year and your principal at the end. A company, we don't really know what the cash flows for Walmart will look like 5 years from now. We might for a bond, but not for the actual company itself. However, it's the same principle of projecting out the future cash flows and discounting back the present value. That's actually, how we value a company. And this is called enterprise value. I have a video talking about enterprise value and equity value. Enterprise value is the present value of the firm's future free cash flows. It's the value of the entire firm. But I digress. What is a discount rate for a company? What is the expected rate of return for the investors of a company? Well, it's more complicated than a bond because, as I mentioned in my last video, a company has all kinds of stakeholders that are receiving different returns. So in reality, it's kind of a weighted average, like the expected rate of return on a weighted basis. One investor might be getting 2% because they're investing in the safe part of a company's capital structure, where the people investing in stock might be getting 20% returns because it's, higher risk. So I'm going to talk about this when I talk about discounted cash flow, the valuation technique to find the value of the stock. Right now, just know we're still using a discount rate, but it's a bit more complicated because of capital structure. So now I'm going to talk about net present value. This is also very important. It is the summation of the present value of cash inflows and outflows for a project. If the NPV of an investment is above zero, then you should invest, assuming there is no better alternative. And I kind of just did a net present value with those bonds. I found the present value of all the cash inflows. And you compare that to the cash outflows and you see if it's a good investment. Let's actually look at that now. So let's say my lemonade business wants to buy a $20 lemonade stand. And net present value is extremely important for a business. If my business wants capital to invest in some project, they need to make sure that that project is really worth their while. And you do this by finding the net present value of any project. So let's say for this project, I want to buy a $20 lemonade stand because I think that will improve my business. Let's say we need capital, and given the risk of this investment, investors demand 10% annual returns. I suppose investments of a similar risk profile are also giving 10% annual returns. This incremental investment into my business will increase the cash flows of my business by $10 for the next 5 years. And in 5 years, I'll need to replace my lemonade stand. So that's why it's not relevant after that. Let's say that because my lemonade stand looks so cool, more people are going to come and buy my lemonade. So that's why it's incrementally increasing my cash flows. So I'm, borrowing this $20 and I'm paying these people, a return for investing. Is it worth my while considering the increasing cash flows I will get? That is basically what the net present value is answering, right? It is answering the question, should I pursue this? Should my business actually buy this lemonade stand? So here's the example. I'm, $20 cash flow, right? I'm investing $20. I'm buying a lemonade, buying this stand for $20. And then for the next 5 years, I am getting these, $10 cash flows, $10 increase in my lemonade cash flows. This is great. So I need to see, okay, is it worth my while? Right now, you would think, oh, $20, $50, yeah, $30. That has to be worth your while. But we also need to consider the discount rate. We need to discount these cash flows back to present value. That's why it's net present value. You need to see, is the present value of all these cash flows, is it worth it? So let's look at this. So year zero, that $20, present value of that, $20. Year one, $10, that's $9.10. As you can see, the farther we go out, the less valuable these cash flows are because of the nature of the time value of money. But if I add up, negative 20 plus $9.10 all the way down to $6.21, the net present value of this investment is $17.91. That's positive. The net present value is positive. After we're discounting back all the cash flows, the present value of all these cash inflows and outflows is positive. So that means I should invest in this project. It makes sense for me. Now I want to talk about internal rate of return. You hear this a lot in finance, also kind of a buzzword. People say IRR. IRR is the discount rate that makes the NPV of an investment zero. So this is used to measure the returns of a potential investment independent of discount rate. So for my lemonade stand, the net present value of this investment will be affected a lot by my discount rate. If my discount rate is just a crazy amount, then the net present value will be a lot different. So internal rate of return, it's kind of internal. It removes the effects of this discount rate because the higher an investment's IRR, the better an investment it is on a standalone basis, not factoring in discount rate, which you do kind of need to factor in at the end of the day, because the return that investors demand is certainly relevant. This kind of just shows on a standalone basis comparing different investments. So let's see about this in practice. So yeah, it's the IRR. The IRR is the rate that we should plug in for discount rate and end up with an NPV of 0. So, I just flipped through here. Let me go back here. So right here, we have 1.1, discount rate is 10%, and the net present value is $17-ish. What is the discount rate? Obviously higher than 10%, at which the NPV would be 0. That is the question that IRR is asking. In this case, it's kind of hard to do this mathematically, like on paper, because all these cash flows are coming in at different dates, but you can do it in Excel using the XIRR function. And here, I figured out that the internal rate of return was 41%. This is fantastic. That means that even if investors in my project demanded 40%, which is still, that's like a crazy amount for an investor to demand. That would be like super high risk. Even with that, this investment would still, have a positive net present value. So at a 41%, the net present value would be 0. So what we often do is we figure out the IRR of an investment. We're like, okay, this investment will give me an IRR of 20%. And then we're like, okay, now what is the expected rate of return? What would investors demand their rate of return be? If IRR is above that expected rate of return, then NPV is positive, because I'm like, okay, well, IRR is 20%, discount rate's 10%. Well, that means, yep, obviously this investment, the NPV is positive. In the lemonade stand case, IRR is 41%, discount rate's 10%. This is a great investment. If IRR equals the discount rate, then NPV is 0. This is not really creating any value. The cash inflows and cash outflows, the present value of them is, equal. If IRR is less than the discount rate, that means this is NPV negative. We should not pursue this investment. It is, in essence, destroying value. And these are the kind of decisions that a business needs to make, on an everyday basis, because a business, for them to grow, for them to grow their cash flows, they need to make incremental investments in themselves. But they need to figure out, are these incremental investments to pursue this growth, are they actually worth it? Can we make NPV positive investments? And if a business is like, nope, there's no more investments we can make where it's going to be NPV positive, what should they do? Should they be like, well, we have all this capital, we need to invest it anyway? No, they should not. It is their fiduciary duty to maximize shareholder value. And that means that if there are no other investments that they can pursue that are NPV positive, they should just return that cash back to shareholders through a dividend or share buyback. Why doesn't a company just return all their cash flows in the form of a dividend or share buyback right now? Why don't they do that? Well, it's because they believe they can make investments that are NPV positive, such so that an investor will benefit from this growth. An investor, they might get a $10 dividend right now, but if the company were to reinvest that $10 back into some other project, maybe a year from now they could get a $20 dividend, and this will be worth its while. And this is why it's so important to look at everything in terms of present value. That's the easiest way to see, should I pursue this investment or should I not? Key to know that a business, if it cannot find any other NPV positive investments, that it needs to return cash, through a dividend or share buyback. In practice, a lot of businesses are overconfident on their ability to find NPV positive investments. I think more often than not, a business should pay out more dividends or do more buybacks than they actually do. They're kind of cocky in their ability to find these NPV positive investments. They think they're better at their job than they are. I mean, don't we all think that? We're all a bit overconfident, human psychology. But all we need to know is that NPV positive investments are the only way for a business to increase the present value of its future free cash flows. As I've said, the value of any investment is the present value of its future free cash flows. To increase that, you need to make NPV positive investments. If you make NPV negative investments, the present value of the future free cash flows will go down. This is a disaster. You don't want this to happen. If businesses do this all the time, if NPV is 0, then that means that it is not destroying or adding value. The present value of the future free cash flows is staying the exact same. So in conclusion, $1 today is worth more than $1 tomorrow because you can earn a return. That's why, the time value of money is a thing. And the discount rate is the expected rate of return. It's all about opportunity cost. An investor will demand they are compensated at the same rate that an investment of similar risk is being, compensated. Also, the NPV is the present value of a stream of cash flows. Very important, the net present value. IRR is the discount rate at which NPV is zero. So IRR is compared with discount rate. If IRR is above discount rate, that means it's a good investment. They should make it. It's increasing future cash flow, the present value of future cash flows. If IRR is below discount rate, that means that it is in essence decreasing the present value of an asset's future free cash flows. So businesses seek to make NPV positive investments to maximize shareholder value. That's how they maximize shareholder value. If they cannot find those NPV positive investments, they ought to just return that cash to shareholders. And that's it for this video. There's a lot of rants. I apologize for that, but this is just super important, these concepts. If you need to watch this video twice to understand it, I understand. This is all complicated stuff, and it took me a long time to learn it. So I'm hoping that I was able to explain it in a way that was easy to digest, but I appreciate it. My next video is going to be a lot about bonds. I'm going to talk about more about those cash flows and discounting them back to the present value, and the nature of bonds, what makes them go up, what makes them go down. I'm going to talk about U.S. Treasury bills and all of those dynamics. So I appreciate it, y'all, and yeah, have a great day.